All right, diving in today, folks, we're looking at something pretty key in the world of financial reporting. How do we make sure those numbers we see actually reflect reality? Well, a big part of that puzzle is ISA 250 revised. You guys flagged this as something you wanted us to unpack, and it's all about how auditors, those financial detectives, deal with laws and regulations when they're examining a company's books.
Yeah, it's interesting because this standard, it's been around for a while now, for audits of financial statements starting December 15, 2017 or later. So it really is the current framework.
So, if you're trying to wrap your head around how we ensure financial accountability, ISA 250, it's kind of essential reading. And we're going to break it down for you today. Big questions we're tackling. What exactly are auditors responsible for when it comes to making sure companies are playing by the rules? How do they even spot potential non-compliance, those red flags? And, why should you, as someone who's keen on understanding this financial world, really care about these auditing standards? They might seem technical, but they matter. Thankfully, we've got our expert here ready to dive deep and give us that crucial context.
Glad to be here. Unpacking this standard, it's like getting a peek behind the curtain of an audit. It shows what they're really looking for and also where those limitations are, what they can't realistically catch.
Perfect. Okay, so let's jump right in. First up, the scope, the reach of these laws and regulations. ISA 250, it makes it clear. Auditors have to consider all this legal stuff during their work. So what does that actually mean in practical terms?
Well, it means the auditor, they have to get a grip on the rules of the game, right? The legal and regulatory landscape that this particular company is operating within. They don't need to be legal experts, but they got to understand the key players, the main rules that apply to that specific business, the lay of the land.
Right. And what I found fascinating in this standard is, how it breaks down different types of laws, right? Some have this direct effect on the financial statements, like how taxes or pensions are calculated. So can you help us see that link a bit more clearly, that direct impact?
Absolutely. Let's take tax laws, right? They're like the financial DNA for how a company calculates its profit. If you mess with that DNA, if you misapply the tax rules, the whole picture changes. The reported earnings get distorted. So, for instance, those specific rules on what expenses you can deduct and what you can't, well, that directly determines a company's taxable income, which then feeds directly into their tax expense on the financial statements. Same thing with pension regulations. They tell you exactly how to measure and report those future retirement obligations, and that gets baked right into the current financial statements. These laws, they leave a clear, traceable mark on the numbers.
Gotcha. That makes perfect sense. If you don't stick to those rules, the numbers themselves are going to be off. But then there's this other category of laws, things like environmental regulations or workplace safety. You have to comply. It's vital for the business to operate. But they don't tell you what number to put in a specific cell in a spreadsheet. So how do auditors deal with these?
This is where it gets really interesting. While these regulations, they might not give you a specific dollar amount to plug into the financials, ignoring them, well, that can create some seriously huge financial risks. Think about it. You violate environmental regulations, you could get slammed with massive fines, cleanup costs, you might even have to temporarily shut down operations. Workplace safety, you ignore that, and boom, you've got lawsuits, lost productivity, all that hits your bottom line. Now, these might not be direct entries in the accounting system at first, but they can have a huge indirect effect on the company's financial health.
So even if an environmental law doesn't tell you exactly how to calculate your revenue, the auditor still has to be aware that, hey, if you mess this up, you could be facing huge costs down the road.
Exactly. They need that broader vision, right? That non-compliance in these operational areas, it can create financial risk, and that ultimately has to be considered when you're trying to present those financial statements fairly.
Now, the standard's pretty clear on this. Ultimate responsibility for compliance that lies with management and those charged with governance, like the board of directors or the audit committee. So where does the auditor fit in? They're not there to enforce every single law.
Right. That's a key distinction. Their main job is to provide what we call reasonable assurance. Basically, are the financial statements as a whole free from material misstatement? Is there any error or fraud that's going to significantly distort the picture? And to do that, they have to consider whether the company is playing by the rules, operating within that legal and regulatory framework. So it's not about being the law enforcement. It's about being that independent set of eyes, making sure the financial picture is fair and accurate with those laws and regs in mind.
And the standard's also upfront about this. There are limitations to what an auditor can realistically uncover. You can't expect them to catch every single instance of non-compliance. So what are some of those big reasons why an auditor might miss something?
Well, think about it. Non-compliance. Sometimes it's deliberate, it's hidden, and it can be very sophisticated. You might have employees colluding, cooking the books together. You might have forged documents. You might even have management deliberately overriding internal controls that are supposed to prevent these very things. That's tough to catch, right? And then you also have to consider that the further removed the issue is from the day-to-day financial transactions, the less likely it is to pop up in a standard audit. So, a violation of a very specific, obscure industry regulation that might not immediately show up in the general ledger.
That makes a lot of sense. So given all that, how does an auditor actually approach this whole compliance thing in their work? What's their main goal, and what are those key things they have to do?
Their main objective, it's all about gathering enough evidence, the right kind of evidence, to show whether the company's complied with those laws and regulations that could directly affect the financials or have that material indirect effect we talked about. And to get there, there are several key responsibilities they have to shoulder.
Okay, so break down those responsibilities for us. The first one, it's about getting a general understanding of all those laws and regulations. How deep do they have to go? Do they need to, like, memorize entire legal codes?
No, it's not about being a walking legal encyclopedia. It's about getting a good overall picture. So they need to understand the industry, the main regulators for that industry, and the general legal and operating environment. So not encyclopedic knowledge, but a solid grasp of the key regulatory areas that really matter to that specific company.
And then there's understanding those specific laws and regs that directly affect the numbers and disclosures in the financial statements. So that sounds more focused.
Exactly. This circles back to those laws with the direct impact, like our tax and pension rules. The auditor needs to know enough about these to judge whether the company's applied them correctly when they put together those reports.
Now, the standard also mentions that auditors need to be on the lookout for other laws and regulations that could have a material effect. So it's like they have to have their radar on for things that might not be those obvious financial regulations.
Absolutely. It's about maintaining that professional skepticism, that questioning mindset, and recognizing that issues in areas that might not seem financial, well, they can still have huge financial consequences. Think about it. You have a company, they're heavily reliant on a specific import license to do business. They need to be complying with all the regulations around that license, right? Because if they lose it, their operations could be crippled, and that would have a massive impact on their financial results, even though the regulation itself might not be directly about accounting.
Right, those indirect links, they can be really significant. And finally, the auditor has to get that written confirmation from management and those overseeing the company that they've disclosed any known non-compliance issues. Why is that so important?
These written representations, they're like a formal check-in. Management's confirming their understanding of any compliance issues and stating they've disclosed everything. Now, it doesn't replace the auditor's own work, but it's a key piece of evidence, right? It reinforces management's accountability and can also be a starting point for further investigation if the auditor finds something that doesn't add up.
Okay, so the auditor, they've got this whole process for considering compliance. But what happens if they stumble across something that suggests the company might not be playing by the rules? What do they have to do then?
When an auditor sees a potential issue, a red flag, the standard's very clear. There are several actions they have to take. First and foremost, they've got to talk to management about it, and if it's appropriate, they also need to involve those charged with governance, like the audit committee.
And what's the point of these initial conversations? What are they trying to achieve?
They're trying to understand the situation from management's perspective, right? What happened, what led to this potential noncompliance, and how do they see it? The auditor needs to gather as much information as possible right at the start.
And then the standard talks about getting even more information to figure out how this could affect the financial statements. What kind of information might they be looking for at this stage?
This is where they start digging deeper. They might review legal documents, correspondence with regulators, internal investigation reports if there are any, and they might even need to consult with legal experts to get a clear picture. They're basically trying to figure out, okay, what's the potential financial fallout here? Could this lead to fines, penalties, legal settlements, or even having to write down the value of assets?
So it's about quantifying the risk, understanding the potential financial hit. And if they conclude that non-compliance has actually happened, how does that change their audit work?
It can have a big impact. They might have to reassess their initial risk assessment, that evaluation of how likely a material misstatement is, because if they've found noncompliance, that might suggest there are weaknesses in the company's internal controls or a higher risk of other issues they haven't spotted yet. And it also affects their judgment about management. How reliable are their statements? Can they be trusted?
And ultimately, this could lead to changes in their opinion on the financial statements themselves, right?
Absolutely. If they think the noncompliance is material, meaning it's big enough to really matter and it hasn't been dealt with properly or disclosed, then they have to consider modifying their audit opinion. They might issue a qualified opinion, which basically says, hey, the financials are mostly okay except for this noncompliance issue. Or in more serious cases, they might give an adverse opinion, stating that the financial statements are not fairly presented, they can't be relied upon.
It seems like the auditor's judgment, their professional experience, that plays a huge role in deciding how significant any noncompliance is.
Oh, it's absolutely crucial. They have to consider both the quantitative impact, the dollar amount, and the qualitative impact. Things like reputational damage or whether the company can even survive this. Can they continue as a going concern? Sometimes even a small amount of non-compliance can be material if it has broader implications.
Okay, let's talk about who the auditor has to tell if they find or suspect noncompliance.
They have a responsibility to communicate this to management, and unless management is involved in the issue, to those charged with governance. It's about making sure the right people within the company are in the loop and can take action.
And how do they decide how much detail to give and who exactly to talk to within management or governance?
It depends, right? The nature of the noncompliance, how serious it is, what the potential consequences are, those all factor in. A bigger, more widespread problem, well, that needs to be communicated more urgently with more detail and to someone higher up the ladder.
We talked earlier about how the audit opinion can change. If the noncompliance is big enough and hasn't been properly addressed, the auditor might issue that qualified or adverse opinion. Are there ever times when they have to go outside the company and report this to external authorities?
Yes, in certain cases, they might be legally or professionally obligated to report to regulators or enforcement bodies outside the company. This usually happens if the noncompliance is very serious, like it poses a risk to the public, or if there are specific laws that require them to report externally. But the exact rules on this, they vary depending on where you are and what kind of noncompliance we're talking about.
Makes sense. Last thing, the standard talks about documentation. What kind of records does the auditor need to keep about all this work on laws and regulations?
They need to document everything. Any instances of noncompliance they found or suspected, those discussions they had with management and those charged with governance, and their conclusions about the potential impact on the financials and the audit report. This documentation, it's like a clear trail showing all the work they did and the judgments they made.
So bringing it all together for our listener, what are the key things to remember about IAASB 250 revised?
Well, the main takeaway is that auditors, they have a crucial role in this whole system of financial accountability. And that role, it goes beyond just looking at the direct financial impact of things like taxes. They need to be aware of how well companies are complying with all sorts of rules, because breaking those rules, even ones that don't seem directly financial, can have big consequences for a company's financial health.
And even though it's ultimately the company's management that's responsible for following the rules, the auditor is that independent watchdog, looking for potential problems and making sure the financial statements are giving a true and fair view.
Right. The auditor's goal is to provide that reasonable assurance, to say, hey, we've looked at things and we're reasonably confident that these financial statements aren't materially misstated. And that includes thinking about the impact of noncompliance. It's all about maintaining trust in the financial system.
Understanding these standards, even if it's just a high-level view, it gives you a much better grasp of how this whole system works, how we try to ensure accountability and transparency. It's like seeing behind the scenes of those financial reports we see every day.
Definitely. It's about understanding the bigger picture, the whole environment in which these companies operate and these financial statements are created.
So here's something for you to think about. We've talked about how audits, they can't catch every single problem. So what other things do you think are important for keeping that trust in financial reporting? It makes you think about the whole system, right? Corporate governance, regulation, ethical behavior, all of that plays a role in making sure the financial information we rely on is actually trustworthy. Thanks for joining us for this deep dive.
It's been my pleasure.